Knowing how to place a stop loss and the thinking behind placing a stop loss is crucial to your trading success. So today we're going to cover the core fundamentals. So if you like today's video, like, subscribe, hit the bell notification. Let's dive into a live chart and really get the core concept and the practicalities of using a stop loss. We're going to use Bitcoin as an example. And the first thing you want to have before even considering a stop loss is a trading thesis. What are you trading and what do you think is going to happen next? And what would void that thinking? And that's where the stop loss thinking comes into play. So, first, I'm going to do it high level, and then we're going to go into a bit of detail. And then we're going to use a couple of platforms to actually show how to place a stop loss with some of the core basics. So, when I'm looking at Bitcoin, I've actually got a long order in play. We believe it's going to go up. But why? Well, what we have in play is something called a double time frame momentum, where the weekly is bullish, the daily is oversold, so the downside is limited. We have this movement to the downside, which looks like a 5-wave pattern. And if you heard me before, markets tend to move in 5s and 3s. So after a 5-wave movement to the downside, you'll typically get a 3-wave move to the upside. So what I'm expecting is a move up. We've got that already. We've got this move down, and we're likely, never guaranteed, but we're likely to get a move to the upside like this. So that's my thinking. So now I want to make money from this. So I gotta say, what is my strategy? Well, my strategy for this particular trade is I want to put in a long order above this swing high, but I want to protect myself from massive losses. How much am I willing to risk to find out if I'm right? And if I'm wrong and I get triggered into the trade, how much am I willing to lose? And also, how do I calculate my position size? So when I'm looking at this, if we just do a bit of detailed analysis, I say detailed, I'm going to do it relatively fast. Mainly what we just said at the beginning. It looks like a nice wave 1, 2, 3, 4, 5. We then look like we've got an A, potential wave A, an A, B, C of a wave B. And then I'm expecting this. This is my thesis. It's not been confirmed, but this is how we make money. We have to make a judgment call before the movement actually takes place. Right, so I got a question mark over here, but this is my thesis. What I'm also expecting in terms of price action is, I'm just going to do a bit of basic analysis here, just in terms of price projections. And again, I'm going to do it relatively fast. But this is important when you're thinking about a stop loss, because I want to get the core concept across. So what I'm thinking here is that it's likely that Bitcoin, based on the momentum pattern and some price ratios, that this is going to happen. So what I now want to do next is think about my entry position. So keeping it very, very high level, I want to go long above this high. I'm going to mark this as green so it's really, really clear for us to see. So I made this line green, so it represents a buy. But what would invalidate this thesis? Where do I want to, if I get triggered into the trade, what should not occur if this is going to happen? If this move to the upside is going to happen, what should not occur? And that's really the stop loss thinking. It's your insurance policy. Because you don't want to place a trade and then have your whole account at risk. We're going to be risking around 2% for the trade to find out if we're right. So when I'm looking at this, I use something called Elliott wave theory. And when we got an A, B, C correction, well, normally, more often than not, that this low should not get exceeded if this is to occur. So we could get triggered into the trade, but then if the market moves against us and it goes below this point over here, I no longer want to be in the trade. I want to be out. I want to tell the market or the brokerage or the platform that I'm using or the exchange, please get me out of this trade. And we're going to review to see what other buying opportunities are there. And that's where the stop loss thinking comes into play. So again, let's just look at this and then we're going to move into a couple of platforms. We've got double time frame momentum. By the way, if you want to check out this double time frame dashboard, it's really, really powerful. I've also built a lot of training around it. You can actually trial it for £1 for 30 days. There's some buy-sell signals. And I put a lot of training into this as well. So it increases the probability of your win rate. So you can check that out. That's in the link below. So we've got double time frame momentum. We've got, it looks like an ABC of a B pattern. There were some price ratios as well. So we believe this is going to happen. So I want to go long above this high. But now I want to put in a stop loss. Where do I want my stop loss? Well, I want it down here at this swing low. Right, so now I have my entry position and my stop loss. So what we're going to go into next is actually going into a platform and placing a stop loss, right? Because I find a lot of people find that difficult at first, and everything in life is difficult before it's easy, whether you're driving a car or whether you're placing a stop loss for the first time. But really, more importantly than how to place a stop loss is the why, the thinking behind it. Because with trading, we're playing a probability game where we are the casino, but we don't have control over the outcome. We have the edge in our favor. So we know if this high gets taken out, I know if this high gets exceeded, this low over here is likely to hold, and this low over here is likely to hold, but it's never guaranteed, right? So even if the market goes up like this, there's nothing stopping it doing this. And we want to be out of the market if this occurs. So we're going to first use PancakeSwap. So PancakeSwap is a decentralized exchange on the Binance network, but you can also use it on the Ethereum network now. And the reason I'm using this is decentralized. So you don't need to have KYC. You can just have a wallet and you can connect it and you can get to business with trading. But what I wanted to just emphasize is a couple of the terms when you're putting in a stop loss. I like to use something called a stop market order for stop losses. It guarantees that the order is going to be filled at the best possible price. Now, it's a bit more expensive, but it means you're protected from the downside. It's your insurance policy that minimizes your losses. So when we're looking at this trade, it's the same chart that we're looking at on TradingView, but now on PancakeSwap. This is that A, B, C potential correction of a wave B, and this is the low over here. So simply what we do is we can look at the open, high, low, close prices. I want to look at this low price over here. I'm going to hover the bar over this low over here, and we can see that the price is 16,233. So simply what we want to do is put in our stop loss order, 16,233. We want to have it as a reduce only order. So this is assuming that you've already got an open position and you're placing your stop loss after your position is open. A lot of platforms also like to do both at the same time, where you can place your order and stop loss at the same time. Now, I will never have an open order without a stop loss. It's a way of being reckless, and it's also a way of just taking unnecessary risk. I don't want to risk more than 2% in this trade, and having a stop loss in play, I know the market goes against me, I'm only going to lose 2%, and I'm safe and I'm secure and I can live to fight another day. If you don't have a stop loss in play, and especially if you're using leverage, and the market moves against you, and it can move against you aggressively, you can wipe out your whole account in one or two trades, and we don't want that to happen. So that's the thinking behind the stop loss. So with PancakeSwap, it'll be the same for Binance, it'll be the same for Bybit, it'll be the same for BitMEX. We're also going to show you an example on MT5, which is another trading platform, very, very popular. As we put in the stop price, what we want is a stop market order. You can use stop limit orders, but the order might not get filled. So when you're looking at your insurance policy, I like to use stop market orders. We want to then say how much of the position. Normally it will be 100% of the position, your stop loss. And if you are placing the trade and your stop loss at the same time, then you won't use reduce only. You'll use a stop loss like this. So this will then become your order for your entry and then your stop loss. And then you simply click buy or sell. So let me just reiterate that again, because I know I covered a lot there. So let's just say you got an order open already. We want to have our stop loss in play for the full position. And because we are going long, and if the market goes against us, we want to sell the full position. So this order will become a sell position for the stop loss. In other words, we are buying, we're betting the market's going to go up. But if it goes down, we want to sell our full position. But the same is true if you're shorting the market. If you're shorting the market and you're in a sell position, and then the market hits a price that is higher, that voids your analysis, then you'll have a buy order in place to buy back the position and take a loss. So again, the real thinking is you're minimizing your losses and you have control. You have control over how much you are risking for the trade. So now let's look at the same thing again, but on MT5. So MT5 is another very, very popular platform. So I've actually got this order in play. So it's the exact order. You'll notice that this is what we were talking about before, 1, 2, 3, 4, 5. And then we're anticipating some type of A, B, C correction to the upside. But we can make money on that wave C on the upside. And that's what we're banking on. We got an order above this swing high. And we got a stop loss below this swing low. You see this red line over here? Well, that's the stop loss in play. And the way it works with MT5, what you'll notice with every platform, the functionality is slightly different. The language is slightly different. The position size is slightly different. So you need to get familiar with the platform that you're using. So if you're using PancakeSwap, if you're using Binance, if you're using BitMEX, if you're using MT5, you got to get familiar. And again, it's really important. Everything in life is difficult before it's easy. And placing your first stop loss is difficult before it's easy. So here you'll just right click on the screen. I'm on Bitcoin on a 1 hour chart. I'll click trading, new order. And the way MT5 works is I like to use pending orders, buy stop to go long. Now, limit orders are actually cheaper to place. However, what I found with markets that move, like really move, often the order won't get filled because the limit order price will get tagged, but the price will go right through and the order doesn't get filled and the price has to come back down and you miss the trade. So I don't like to pay a bit more, but I'm happy paying a bit more to make sure the order gets filled. So buy stop just says, get me filled into the market at the best price once this trigger price is hit. The volume is the size of the trade. Then the main thing I want to focus on is this part here, the stop loss. So the entry order is above this swing high. It's on 16648. So 16648 will be the entry. But the stop loss is this low down here. So again, what I'm looking at is the price of the low over here is 16,243. So 16,243. You can make any notes. I like to call this unit 1. I always enter 2 units, unit 1 and unit 2. And then the type of order. So this one is GTC. That just stands for good until cancelled or good till cancelled. You can change the order type. I like to just keep it open. And then I will put alerts in play. So I know if the price action does a particular thing before getting triggered, I can take whatever relevant action. So now once we're happy with that, we literally press place. The order is placed and there's no more actions required. I am going to show you one more thing though, just a nice little trick. Oh, it's not really a trick, but it's just very, very helpful, is alerts. I like to put an alert on TradingView, and if this lets me do it, let me see if it lets me do it. Yeah, here we go. It's a bit slow there. And I just want to know when am I entered into the trade. So I'll just put the word entry into play. So now if the price goes above this point over here, I'll get an email that says you've been triggered into the trade. I also want to know if the stop loss price has been taken out, because sometimes the stop loss price will get taken out before you're triggered into the trade, which may void the whole analysis. So then you just need to reevaluate. So let's put that alert in play as well. I'm just going to put in stop loss. And then last but not least, I like to adjust my stop loss at a logical, mechanical manner to minimize my losses and also bank my profits. That's important as well. So let's just cover that here as well whilst we're on the topic. So what I'm going to do is I'm just going to talk through my trade plan for this. So the thesis is we anticipate that the market has a good probability of going above this high. If it goes above this high over here, what should the market not do? Well, then it shouldn't go below this low over here. So do I want to keep my stop loss down here? I go, no, I want to move it to over here. So then you can edit your stop loss. You can edit your stop loss. Every platform is slightly different, but you can edit your stop loss. And if your platform doesn't allow you to edit the stop loss directly, You can just place a new stop loss and cancel the old one. And then what I want to do is if the market really takes off, let's just say it does this. Let's just say the market starts to move like so. It goes up, comes down, and then continues up again. At this point, where do I want my stop loss? Do I want it down here still? I go, well, this is a new swing low and it's above the entry point. So what I will do is I'll then move my stop loss to this point here. And the thinking behind it is saying if the trend is to continue to the upside, we should not get a wave overlap. We shouldn't see the price overlap into the former wave peak. And it shouldn't take out the previous swing low. If it does, something else is happening and we want to be out of the trade. And by moving your stop loss at this swing low, this is what you call being risk-free. In other words, your stop loss is now above your entry point and you're guaranteed a small profit, right? So it's break even or a small profit. And that's a really powerful place to be because now it's saying if the market does this, which is always a possibility, you get stopped out, you're exited of the trade, but you've made money or you've broken even or you've taken a small loss, you've minimized your loss. And then you just literally rinse and repeat and do the same thing again. And on the flip side, if the market moves up, goes down and continues up, and then you move your stop loss here, and then it continues up, moves down, and then continues up. Well, where would you move your stop loss? Well, you'll move it to this swing low over here. And what you're going to be aware of and want to be aware of is that this wave C often breaks down into a 5-wave sequence. And it looks like a 1, 2, 3, 4. And it looks like it's on the final part of the market of a potential wave 5. Now, when you see that, that's when you want to really start getting your stop loss really tight to the market. And there's different strategies on doing that. And normally something like a 1-bar low or a minor swing low on a lower time frame. In other words, you're getting your stop loss really tight to the market. So if it does then reverse, you maximize your profits at the peak. Sometimes it overextends and goes further up. But then what we're anticipating is going to occur afterwards is a continuation to the downside, which is this movement over here. So today we covered stop losses. The real thing is the thinking behind the stop losses and then how to apply and place the stop losses and get familiar with that process. I personally would not take a trade if I'm trading the markets like this with technical analysis without a stop loss. Because if you're trading without a stop loss, you're under the thinking that you know what's going to happen next, which will then lead to risking too much, which would then lead to major drawdowns, which would then lead to blowing your account, and you have to start from scratch, or you get put off from trading long term. The first thing is survival, then it's steady growth of your equity curve, and then it's profit. If you can't survive, then you can't win. And by being the casino, it's all about having the edge in your favor and then being consistent over time. So double check the double time frame momentum dashboard. This is a massive edge. Whatever strategy you're using, if you can trade in the direction of the trend, you're going to have a higher probability of success. And the double time frame momentum dashboard is a phenomenal trend identifier that can be a powerful tool in conjunction with whatever you're using as well. So if you like today's video, like, subscribe, hit the bell notification. Let's finish with a quote. We're going to go with chapter 3 today from my book. I like this quote. I believe it's Confucius. I was saying this to my wife the other day because she's looking to do some new things. And I just wanted to remind her. And I said, look, Confucius says the following. It does not matter how slowly you go as long as you do not stop. Stop losses can be difficult at first to master. But once you've got it under your belt, then it's easy. And that's like with most things in life. Everything in life is difficult before it's easy. So understanding the thinking behind using a stop loss and why you should use one is actually more important. But then knowing the practicalities of how to place your stop loss, making that second nature, and then doing it time and time again with every trade, and being comfortable with being stopped out. Stopped out is a good thing. You've just minimized your losses. Stop your losses. Now you can fight another day. If you didn't have that stop loss in play, the losses could have gone from 2% to 10%, 20%, 50%, 90% of your account, if not your whole account, right? So stop losses are insurance policies to protect you. Let me repeat that. An insurance policy to protect you from the downside. And that ensures long-term survival. And then by being right 20, 30, 40% of the time, those losses are going to be accounted for in the long term. And it's all about the long term. Really, really important. So like, subscribe, hit the bell notification, and let me know how you find using stop losses.